A record-breaking session for our markets today. We're talking with Sameer Arora and Mark Matthews. Welcome back to the show. Mark, as of now, to your thesis, what are the big risks that you see?
Always put me on the spot when you ask about those because, to my mind, the risks that always end up being the most impactful are the ones that we don't see coming. And for example, if you told me a year ago that interest rates are going to go up 500 basis points and we would have quantitative tightening and all those other sorts of things that have happened, I wouldn't have said, well, then Silicon Valley Bank is going to blow up. So it did. And I guess what I'm trying to say is that we never really know what the risk is that comes along and takes the market down. It's usually one that we weren't looking for, or we didn't know when it was going to happen. I mean, obviously we can look at commercial real estate in America, for example, and say that's a big risk. But when does it actually become so problematic that it starts to take the market down? I mean, it's impossible to say. So that's how I'd answer that question.
Right. And
so the risk which matters is the one that you don't see coming, right?
I mean, no one saw COVID coming. No one saw a lot of that's why the black swan, right? That's what they keep talking about. But Sameer, I want your thoughts as well. Usually when markets are at record highs, we are seeing decent flows, everything looking good. Even a slight bit of a risk can actually, topple the apple cart. Yeah, go ahead.
That's because you are calling it record high and all, and I'm calling it that's moved up 5% this calendar year.
Okay.
And it was 2-3% last year. And the currency has depreciated 10%. So let's say that we have not even started yet.
Even started yet.
And the other thing, in terms of risk, maybe not right now, but in whatever I've read in the recent 3-4 months, is more to do with China's view on Taiwan and whether they take that plunge or not. A few books I read said that, this book called Avoidable War, basically saying before 32 it can happen anytime, and maybe it becomes serious in this government of the US or the next. But so these things we'll never know, and you won't know how to plan for it.
Yeah.
But these will be low probability but very high impact events. To the Ukraine war, which if you had asked me one day before the war started, I would have said nobody does wars these days.
I mean, I was in Kerala over the weekend and there was I was getting messages saying coup in Russia, Wagner.
Wow.
I mean, and who would have thought, right? Russia? I mean, but yeah, absolutely. So it'll be the one which we don't know and we're not discussing right now. We don't know when something will occur.
But let me just say one thing.
Yeah.
That you see in the last 20 years where India has done very well and actually even ahead of US in dollar terms, what all has not happened from global financial crisis to demonetizations to COVID and previously attack on Indian, the hotels, Mumbai, whatever, and so many other events, scams breaking out, droughts, change of government which led to a 17% fall in one day in 2004. Many things have happened, and then over time people move on. That is the beauty of the markets.
Okay, it heals and keeps moving higher. Okay, I got that. I just want to come back to very briefly, since Sameer, you said that this China plus one is a big theme. And I'm talking purely from an angle of portfolio flows, not diversification of supply chains and setting up of factories, but purely flows. I read again in the FT, Amundi, which is one of the largest European funds, saying that we got the most certainty in China, and people have overdone this China pessimism to a very large degree. I don't know. And the headlines say they're moving assets from US to China. How do you read it? Yeah.
I think that these are people who are already stuck in China, having to defend it beyond national this thing. Because at the same time, we heard some Canadian pension fund, one of those 2-3 names, saying they're closing down their Shanghai office.
Yeah.
And we attended a conference in Mumbai where I think University of California CIO, endowment CIO, saying we don't invest in China. And for them to say it publicly. And then so many other things are obvious that many of, this Sequoia, China had to basically break away from Sequoia.
Correct.
Today, right now, NVIDIA is down 3% because the US is restricting technology export of these chips to China. So there is effectively a fight or a Cold War type or something, not maybe that bad, And China, and so many of the pro-US and who believe that China is as much a strategic threat, because the Sequoia was questioned as to why they were making investments in defense-related Chinese companies. And so there are so many angles that for X% of the market, doesn't have to be 100%, if they change their view or they become, not that they have to sell out of China, not that we are replacing China, we are only saying that the 29% index weight, if it becomes 25, I think it'll be much lower, maybe already. That 4, 5, 7%, the biggest beneficiary of that is India, and we don't even need all of it because our base is 14%. So you give us 3 more percent, that's a 15%.
All right.
I think China is still 30%, Samir. The last I checked.
I think 29.
Yeah, 30. Yeah. So I mean, a few percentage points can make. I mean, that's.
That for a long time we've not had FIIs and DIIs buying together, at least not last year and not in 18. And if the FIIs come and separately the DIIs also are getting inflows, which they are and which they will continue, and one day I'll also be a DII. Well, the fact that both want to buy would be a good situation to be in someday down the road.
A couple of $1 billion in the previous month. We're not even done with June yet. We have $1 billion coming in June from the FIIs. Mark, by the way, are those bananas on your tie by any chance?
Giraffes.
Oh, they're giraffes. Okay.
Thank you for noticing.
Everyone is talking India, sort of maybe going over bananas, so that was a mark. But speaking about giraffes, which one do you think will be the taller sectors in India? I mean, the ones that will outbeat the market, so to say. Samir has given a 13 to 14% sort of historic rate at which the market will sustain going forward. The sectors that you're most bullish on in India?
Well, I just always come back to the banks. The banks are the heart of any economy. And if the Indian economy is going to grow the way we think it will, then banks will benefit from that. And of course, they just walked through this valley of writing off NPAs for the last 10 years, legacy NPAs from the go-go years of the 2000s. But I think they're now in a very good position to lend. And as I mentioned earlier, capacity utilization is in the high 70s, low 80s. So I know we keep talking about this every year, this CapEx cycle that's about to happen. But this time I really think it is. What I'm hearing anecdotally from our clients really is that they're getting a lot more business and they need to finance it.
And speaking of giraffes once again and the banking sector, do you think it's time for the bigger ones to dance, HDFC and HDFC Bank? I mean, post the merger, do you think the flows that had paused before the merger, post-merger, will return and we see this giraffe dance?
I don't see why not. I mean, obviously, one of the best brand names in finance in India, why would it not benefit from the economy growing and people wanting to borrow more?
Giraffe dance, elephant dance, elephant. I mean, it's the biggest one.
If he had elephants on his tie, I would have made the elephants dance. Now he has giraffes on his tie, so maybe let's.
I think Samir should be smiling year to year. HDFC Bank.
No, actually, I am only smiling that with HDFC Bank being number one and not moving for 3 years, how did we manage to beat the benchmark? Because it's not even in our benchmark, which is MSCI India. So the point is, I think it's a piggy bank. I am building on that now. My performance out of this for 3 years, we have nurtured it and sustained it.
Yeah.
And actually, if foreign flows come, then the X%, whatever be that percent, 6, 7, 8%, or if not 10, they will end up buying HDFC Bank. Because it's, first of all, you cannot feel bad buying it because you'll say, although I'm coming in now, oh, by the way, I'm getting the price, which was, say, whatever, 1.5, 2 years ago or near that. And that itself makes it psychologically easier to allocate now. And plus, they are doing very well on their own. And then these issues of merger and who has to sell and the mutual funds weight is more, all that will play out in 30, 40 days. So after that, if we are believing that the FIs will come in, this will be one of the easier things for them to buy.
And the places you would avoid would be?
Well, right now, because I've been avoiding tech for a year, I'm pushing my luck and going to wait for next month, which is this July, see the results and then see what happens. But right now I have basically zero weight in IT. So far doesn't mean that I intend to have that forever, because generally we like top down these three themes, which is financials and consumer and IT. But right now, just because we say we like them doesn't mean we have them every day. And after 26 years, I've not had them for even 1% for like 1 year, which is too much for me. But right now, I am pushing my luck a little bit, yes.
All right. Financials, consumer, and IT, right? Those are the three areas where you look for opportunities. Gentlemen, wonderful chat today. Thank you very much for joining us. Samir, appreciate you joining us on short notice. Mark, thank you very much for being with us here on CNBC TV18. From Mangalam, me, and everyone here on the team, it's goodbye. Thanks very much for watching.